So the China deal, we inked the deal. You remember we had a trip to Geneva, and then that was being slow played. We got back together in London, and that deal was signed and sealed 2 days ago.
Remember a few months ago, the press was saying, do you really have anybody of any interest? Well, we just signed with China yesterday, right? Just signed with China. We have everybody. We're not going to make deals with everybody. Some we're just going to send them a letter, say, thank you very much. You're going to pay 25, 35, 45%.
President Trump says the deal is done with China. Lutnick calls it a breakthrough, but the clock's still ticking with trading partners worldwide scrambling to strike their own agreements before that July 9 deadline. Live from Sydney, this is Insight with me, Paul Allen, where we dive deeper into the market headlines that matter with crucial context and sharp analysis. Let's start with Nike shares surging in late trade as revenue beats the street. The sports apparel giant's warning, though, that tariffs could cost it $1 billion. Morningstar's senior consumer equity analyst David Swartz is going to join us to dig into the importance for Nike of a US-China trade deal. Also, Xiaomi stock hitting a record after its new SUV with a $35,000 price tag draws big orders. Is it, though, a Tesla killer? We're going to ask Automobility founder and CEO Bill Russo about that and his view of China's overheated market for EVs. All right, let's start off with a look at how global markets are performing. Pretty much a risk-on day when it comes to equities, at least. We're seeing a pretty decent bounce in China. Hong Kong also better by about a 0.5%, let's call it. The Nikkei pushing higher as well. It's really a theme here of a de-escalation, both in terms of what we're seeing in the Middle East as well, but also the progress on the trade front. As we mentioned there, it looks as if the US and China have finalized a trade understanding, a deal which was reached over a couple of meetings in Geneva and London, although it must be said we haven't heard from the Chinese side yet on that. The Hang Seng, meanwhile, heading for its best month since the start of March. It's been outperforming mainland Chinese stocks pretty strongly so far this year as well. We had industrial profits out of China as well, perhaps not such great news there, contracting 1.1% in May, where a modest expansion was expected. Also, the pressure on Jay Powell at the Fed does continue. Jay Powell, though, is, of course, a Trump appointee himself, so he's living proof that your chosen candidate doesn't always behave in the way that one might anticipate. We have heard from a couple of Fed officials over the past 24 hours. Let's hear the latest commentary.
If the tariffs are a one-off, you can look through them, and if they're just not going to materialize, then you have to watch both sides of the mandate. Ultimately, we have to watch both sides, and that's what I'm doing. And then the fall looks promising for a rate cut.
There's still considerable uncertainty about tariff policies and their effects. Monetary policy is well positioned to allow us to wait and see how economic conditions unfold.
The U.S. Commerce Secretary Howard Lutnick says the U.S. signed a trade deal with China 2 days ago. Speaking to Bloomberg, he revealed that they've finalized the understanding which was reached last month in Geneva.
So the China deal, we inked the deal. You remember we had a trip to Geneva, and then that was being slow played. We got back together in London, and that deal was signed and sealed 2 days ago. President just said it just the other, 15 minutes ago. And then he also suggested that we are, of course, at the very close finish line with India. Of course, the way these deals happen is their prime minister and their parliament have to approve it, and the president likes to close these deals himself. I mean, he's the deal maker. He loves to close it. I think we have deal after deal after deal. The president's going to make his calls. He's going to decide exactly the finishing touches on them. And then what we're going to do is we're going to lay out a structure of all the different kinds of tariff arrangements with different countries, right? There are countries with huge deficits. There are countries that are balanced. We're going to set that all up and get that ready for July 9th.
So it sounds to me, Secretary, and correct me if I'm wrong, as I listen to you, that we either get 88 deals announced in the next 2 weeks, or there's going to be action one way or the other by this administration that July 9th will be conclusive. If there's no deal, here's the new reciprocal tariff. Is that right?
Of course. So what we're going to do is we'll announce some deals, but basically the deals we're going to announce are sort of the head of the class, the structural spot in the line, and then all the other countries will fit behind those categories, right? So we're going to do top 10 deals, put them in the right category, and then these other countries will fit behind. So you'll have South American deals and you'll have African deals. You'll have it all structured and set up, and that's the model how you do leadership, and we will put these people in their proper buckets on July 9th. So those who have deals will have deals, and everybody else who's been negotiating with us, they'll get a response from us, and then they'll go into that package, and July 9th will go forward. And as the president said, if people want to come back and negotiate further, they're entitled to, but that tariff rate will be set, and off we'll go.
That's U.S. Commerce Secretary Howard Lutnick there. Well, if you want insight into just how high the stakes are in the U.S.-China tariff standoff, look no further than Nike. The sports apparel and shoe giant just dropped its fourth quarter earnings, and the stock jumped in late trade as revenue beat Wall Street's lowered expectations. The real headline, though, was the looming cost of tariffs. Nike says that new U.S. levies are slicing into margins, especially on Chinese imports, and could cost the company up to $1 billion. China still produces 16% of Nike's US-bound shoes, and the company's scrambling to cut that number. Even though its fallback, Vietnam, isn't safe either, with Trump tariffs hitting there too. For more on this, let's bring in a Bloomberg Intelligence senior analyst, Catherine Lim, and Morningstar senior consumer equity analyst, David Swartz. Catherine, I want to start with you. Just speaking to the trade deals more broadly, how much encouragement can we take from the announcement that Howard Lutnick has made earlier today? And what detail do we really have about what's going to happen next? Still a lot of countries to reach agreements.
Right, I hear you, Paul. And really what I'm looking out for is that Nike actually indicated this morning, Asia hours, that they are looking to actually sequentially raise their prices through the course of this new fiscal year. So what I really be keen to see is that, as we start to actually see some of the tariffs deals comes through, the final impact on the cost, and let's say it's, 1 billion or maybe even a little lesser, depending on what materialize. What will happen to the U.S. prices? And I think that is key. I mean, for all you know, that we can actually be looking for positive surprises for margins if they manage to still garner the kind of demand after instilling price hikes.
In terms of reorganizing the supply chain, though, I mean, there has been some reduction on the reliance on China, but is anywhere really safe unless you're setting up a factory in the US? And how likely is Nike to homeshore substantial amounts of production?
Well, Paul, setting up factories in, U.S., it's easier said than done, and it takes time. Really, we're talking about supply chain and not just a singular factories. Everything from, raw materials, input, textiles, etc. But, again, the shifts outside of China into Southeast Asia, into other markets, that's been ongoing, for more than 5 years right now. And I do think that, essentially what has come through from Nike is that, they're going to continue to actually make that shifts and that reallocation. And shoes, they mentioned that, the percentage that's going into US from China, that's going to drop to a single digit. So, going forward, any impacts of that, it's fairly containable.
All right, Bloomberg Intelligence Senior Analyst for Consumer and Technology, Catherine Lim there. Let's get to David Swartz now, Senior Consumer Equity Analyst at Morningstar. David, we've had a bit of a snapshot there of Nike earnings, what's going on. I mean, sales did fall, although less than anticipated. Considering now that a trade deal seems to be getting substantially closer, how would you characterize the importance of the coming quarters for Nike, and what might we see there?
Nike has gone through a very tough period over the past year and a half, really. And this past quarter that was announced today was probably something like the bottom. I do think that we could see some more sales declines, but I think that we'll see margins start to rise too. Nike had very low margins in the quarter. Its sales were down 12%, and its operating margin was under 3%. So, and Nike traditionally has double-digit operating margins. So it was a very tough quarter, and it was a very tough fiscal year for Nike in fiscal 2025. And looking ahead, now we're in fiscal 2026 for Nike, and it's probably going to be another few quarters before we really see evidence of a turnaround. The tariff situation is not helping. It's making a bad situation worse for Nike, and it's making it even tougher to have a good visibility on when a turnaround might happen. That's true for analysts, but it's also true for Nike's management. And so, I think that Nike is on its way to fixing its problems, but it's not going to happen in the near term.
Catherine mentioned there, and we were discussing it as well, that about 16% of what the US imports from China, Nike makes about 16% of it in China, is working to reduce that. Realistically, how much lower can it get it, and where can it set up its factories, which is going to be safe from any other trade and tariff reprisals?
Well, there is no safety. If the original tariffs from April are reimposed, then Nike's in a lot of trouble, and so is everybody else. So is the whole U.S. economy, for that matter. Nike does not own a single factory in the entire world. So Nike cannot do its own production. Nike outsources all its production. Most of it is outsourced to Asia. Its biggest sourcing country is Vietnam. Vietnam was hit with very high tariffs on the original tariffs in April. There's no rhyme or reason for it at all, because it's unclear, what Vietnam could even do to try to reduce its trade deficit with the U.S. But if those tariffs are reimposed, then Nike is definitely in trouble, because it cannot overcome a 46% tariff on imports from Vietnam. It can move some production from China to other countries, and that is what it's doing. But at this point, it has no visibility on what tariffs will be imposed on what countries. So that makes it almost impossible to know what changes it should actually make in its supply chain.
Yeah, let's talk about that a little bit more, because a lot of the focus is on the progress made in the China deal. But from Nike's perspective, is a potential U.S. deal with Vietnam even more important?
None of these tariffs are good for Nike in any way. And these so-called trade deals, I don't even know what they are. Are they going to set tariff rates that are higher than they were a year ago? If they do, then what kind of deal is that? That's a deal where everybody ends up worse off. So I don't know what kind of deals we're even talking about at this point. But there's no escape from the tariffs. If the original tariffs from April are reimposed, there's nothing that Nike can do about it, because it's totally dependent on Asian manufacturing for its entire worldwide business. Now, it does have a benefit in that the U.S. is only one of its markets. Nike is a global company that sells in 190 countries. And so if it needs to raise prices in the U.S. to offset tariffs, it can do that to some degree, and it would not bankrupt Nike. It would hurt Nike, but it wouldn't be fatal. It would be fatal for smaller apparel and shoe companies, certainly, but Nike would survive it.
Mm-hmm. Let's move on to some safer ground, some things that perhaps we don't need to guess about as much as we do when it comes to U.S. trade policy. But, you take a look at, say, the greater China market, which you describe as very challenged. How is your outlook for China, and are there some opportunities that Nike could take advantage of there?
Yeah, the Chinese sportswear market is critical to Nike and to the whole industry. It's the second largest sportswear market in the world now, behind only the U.S., and for many years, it was the fastest growing. Now, it has been struggling recently because of China's economic problems with high youth unemployment, and sort of the trade war is certainly making that worse too. And so, that has affected Nike. It's affected other sportswear companies that do business in the country. Nike has also suffered because there has been some move by Chinese consumers to consume local products. So we've seen Anta and Li Ning and Xtep and others that have done better in recent years, and that's been to some degree at Nike's expense, as well as Adidas. But Nike has 6,000 stores in China. Most of them are franchised. They have a big presence there. Nike has sold in China for 40 years. And it's still the #1 brand in the country in sportswear. And so I do think it has a good chance to come back there, and that it can be a very profitable and fast-growing market for Nike again. But it looks like that turnaround is pretty slow right now. And so it could be several quarters before we see a lot of progress.
We also saw the Bloomberg Intelligence made a few notes about inventory levels at Nike. They're looking kind of flat, but when you look at inventory, is there any concern there about the amount of unsold, unwanted products that the company is sitting on?
Yeah, it is a problem because the sales are declining. So, flat inventory really means that the inventory situation is not getting that much better because Nike sales were down 12% in the quarter. So you'd like to see inventory decline faster than that. But it isn't just a matter of selling down the inventory. It's also a matter of selling down slow moving and lower price, lower margin inventory. That's what Nike's really trying to do now. It's trying to get away from excessive discounting of some of the big franchises like Dunk and Air Force One, and to make room for some of the newer products that it has coming out over the next several quarters. And hopefully they can sell those products at higher prices without discounting. And that's really the goal right now, is to fix the inventory issues in all territories. That is being complicated, though, by the weakness in some markets like in China, as we just discussed.
Well, we saw a pretty good post-market reaction to this announcement, shares jumping 11% after the close. What sort of reaction do you expect to see at tomorrow's open in the US?
Yeah, it's hard to say. I think that Nike stock is extremely undervalued. I think the stock is worth over $100 a share. So I actually think it's quite attractively valued at this price. And so I don't think it would take a lot to actually move the stock higher. The stock has been at multi-year lows. And there's good reasons for that because it has had a very difficult period. But, it's also a very strong company with, $9 billion in cash. And, one of the benefits of the stock price being down is that it's been able to buy back stock at very attractive valuations, in my opinion. And, it's hard to say what the reaction will be exactly. But I think if we get some clarification that the tariffs will be delayed again or they'll be canceled or whatever, whatever happens there, that would probably help. And then also just an indication that Nike is sort of near the bottom. I think we're going to see probably some sales declines for the next couple quarters, and then maybe it gets back to growth rates, in positive territory, and that will show people that Nike's plan over the past several months is actually working. Remember, it's been less than a year since Nike brought in Elliott Hill as a CEO, so it hasn't been that long considering the problems that he inherited. So investors understand that, and they're going to be looking ahead to see evidence of a turnaround happening.
Well, Morningstar, obviously, who you're working for, you've got a buy rating on Nike. You've just outlined a fairly bullish case for us. But, if we take a look at the chart, as you say, the trend's not fabulous. We're down 17% on year, down about 60% from the 2021 peak. You just mentioned that $100 price target. We're at $62.54 right now. That's quite a long way to go.
Yeah, it is. And, there was a time when I thought Nike was way overvalued when it was at its all-time highs, like around $170. And now it's done a complete reversal. There was a time when I think people were overpaying for Nike. And now I think they've given up on it a little bit too much. People are acting like it's a dead brand or something like that. And that's just simply not the case. Nike is still the number one or number two sportswear brand in almost every country in the world. And, it's still far bigger than Adidas. Adidas' stock price has had a big run over the last several months. And there was a time when Adidas was in worse shape than Nike is now. A couple of years ago, people were acting like that company was dead, and it's had a resurgence. So that can happen in this industry. It's still a very attractive industry, sportswear. It's one of the very few really growth areas in the worldwide apparel market. And it is a global market, and it's one that Nike dominates despite its problems. And so I think there are reasons to think that it's very cheap and interesting at this price.
All right, David Swartz, Senior Consumer Equity Analyst at Morningstar. Thanks so much for joining us with your insights today. Still to come this hour, Goldman Sachs Asia Pacific President Kevin Sneader is going to weigh in on US-China trade tensions and what Beijing needs to do to get foreign investors back on board. That exclusive conversation coming up. This is Bloomberg. The Goldman Sachs Asia-Pacific executive says uncertainty over US-China trade tensions looks set to run for some time, despite the recent tariff truce. Kevin Sneader also told us what he thinks Beijing needs to do to get foreign money flowing again as investors look beyond the US.
I think we're really debating what happens to the incremental dollar. And you start to think about new money. Where's that going to go? And I think when you think about it that way, then there is definitely more interest in looking at places beyond the US. And that money may go to China, but there's a high bar in it going to China. And the bar is one of the talks remain very positive. I was at the WEF in Tianjin, and we heard a lot of statements that would give one encouragement around consumption, the importance of consumption, the desire to keep reform and continue on the journey. Lots of reasons to have hope, but fundamentally investors want to have three things: the consistency of policy, clarity of direction, and transparency around progress. And I think once those three things line up, more money will return, I suspect, to China in volume. But at the moment, we're still in the wait and show it to me phase.
And tariffs. How concerned are you about tariffs? And we're just about close to that July deadline for many of these countries in Asia, and how they deal with the U.S. now.
Well, isn't it remarkable that despite the fact the tariff deadline is nearing, you look at the markets and you see them continuing in a very positive stance? That may be a place where we could all regret the fact there hasn't been enough attention on the less than 2 weeks that there is between now and July 9th. And I think the reality is there's a lot of questions on tariffs. There's a lot. At one moment you think it's quieting down, but then you remind yourself at this moment in time there's a framework agreement and a deal with the UK. But beyond that, there's not a lot. That will change, or I suspect that will change. But it means that the uncertainty, are we past peak uncertainty on tariffs? I'm not so sure. And yet many people have put it in the rear view mirror. I think in truth on tariffs, we won't know until we get the latest messaging around what is being expected of different geographies. And it's only once we know that. I think one thing we do know is that with regard to the big bogey, which is China, and the China-US discussion on tariffs, August 12th would be the 90 days there. That one looks like it's going to run for quite some time. And I suspect we're going to see that really be a long process. And it's only once that process is underway we'll get a sense of, is it going to be something akin to what we saw in the phase one tariff discussions and agreements back in 2018-19, or is it going to be something more abrupt?
That's Goldman Sachs Asia-Pacific ex-Japan President Kevin Sneader speaking there to our colleague Yvonne Mann at the Bloomberg Sell-Side Forum in Hong Kong. Let's take a look at how benchmarks are tracking in China and Hong Kong at the moment. We're seeing a modest risk-off tone now for the CSI 300, just softening by a few points. The Hang Seng Index also flat, so giving up some of those earlier gains we saw around optimism that there has been some progress in the US-China trade talks. Hang Seng Tech Index, meanwhile, hanging on there. Let's take a look at the currency space as well. Yen holding steady at 144.33, but we're watching the Taiwan dollar as well. That is continuing to strengthen. It's now trading stronger than 29 US dollars for the first time since 2022. So that could have some interesting implications for earnings growth down the track, which typically arrives with a lag. Also, we've got US futures pointing higher as we look ahead to the final trading day of the week. We just did mention Nike having a good after-hours pop, so that's one to watch in the open as well. Coming up, we're going to talk about Xiaomi shares hitting a record as well after the launch of its new SUV to take on Tesla. Welcome back. You're watching Insight. Xiaomi shares have touched a record high after strong initial orders for its new $35,000 SUV intended to compete with Tesla's Model Y in China. The company says it got over 289,000 pre-orders for the YU7 within an hour, and that exceeded analyst expectations. The new model is going to be a test of demand for Xiaomi cars after a fatal crash which involved a different model, sparking scrutiny from Chinese authorities. Let's get to Russo now. He is founder and CEO of Automobility, a global strategy consulting and investment advisory firm. Bill, thanks for joining us. I just want to start by getting your reaction to those numbers. I mentioned more than 200,000 pre-orders in a matter of minutes. When you see numbers like that, what do you think?
Yes, Xiaomi's a different type of a disruptor. They're not just an EV company. They're creating a fully integrated digital ecosystem value proposition, which in China, the world's biggest digital economy, resonates very, very well. They're bringing the smartphone mindset to the vehicle and treating the car as a smart terminal. The SU7 sales have been impressive. They sold north of 270,000 units in just over in about 14 months. This model is actually the YU7, the second model, which has that impressive opening in terms of pre-orders, is an even larger segment of the market. So I think you're going to see a pretty strong positive momentum for this company going forward.
Yeah, these are good ideas that Xiaomi is putting forward, but almost certain to inspire imitators as well. So can demand for the YU7 be sustained in what's a very competitive Chinese market?
Yeah, I think, first of all, if you copy hardware, that's one thing, but this is not a hardware-only company. This is a device company. They have an ecosystem of Xiaomi users of other smart devices that number in the hundreds of millions. There's more than 600 million devices that carry a Xiaomi logo. This is a well-accepted consumer electronics brand entering a new space, one of significant size. The biggest computer that you're going to interact with on a daily basis is actually going to be the one with wheels on it. That's the car. They recognize this opportunity. They've entered it. And in 1 year with one model, they're outselling Tesla in China.
So do you anticipate that Xiaomi might add some more models after this, or do you think they're just going to focus on doing a couple of models, but very, very well?
I think the way you attack a market is don't overly complicate things. I think go to the big segments. They've done that now with the sedan, the SU7, now the YU7, which is an SUV, a bigger segment. So when I say they sold north of 270,000 units, expect even more volume for the YU7. I think that's one thing that they learned from Tesla is don't oversupply the market with too many different variants. But that doesn't mean you can't enter other segments. There are other product configurations that are possible for Xiaomi to enter. I think this is just the beginning of their journey to become a global smart EV company.
All right, so I mentioned competitors a moment ago. How do Xiaomi's competitors come up with strategies to counter what is a fairly compelling ecosystem of cars, phones, and other devices?
Well, the main competitors for them in China are going to be BYD, the largest new energy vehicle company. I'd say BYD is not a digital native. I think BYD's claim to the market is going to be through super scaling the hardware and trying to compete by presenting as a smart terminal-like interior configuration, which is what Xiaomi is doing. But BYD's ability to compete is going to be based on their scale and their ability to price aggressively. The other big competitor for them is going to be Ito or the Harmony Alliance, which is Huawei's ecosystem. Huawei is the other device maker that is competing in this space. And there are other smart device companies, but none as capable as Huawei is in terms of delivering the total hardware and software integrated human-machine interface type of a solution. So I'd say those are the two main competitors, BYD and Huawei for Xiaomi.
And conspicuous by its absence in that list, Tesla. What can Tesla do to improve its competitiveness in China?
Yeah, well, Tesla's the pioneer. Obviously, they have software-based, and I think as pioneer, you get consideration. But Tesla's business in China has been under pressure. They're down. Just to give a number, the market for new energy vehicles in China is the only growth segment in the market. It's 40% higher this year than it was last year, but Tesla's sales this year are down about 8%. So that tells you that Tesla's model lineup is aged. The Model 3 launched in 2020, the Model Y in 2021. So they lack the freshness of companies like Xiaomi. And quite frankly, they don't have the digital ecosystem localized in the way the Chinese consumers want them. So I think these smartphone companies, these smart device companies jumping into the automotive industry with hundreds of millions of people that use their smart devices, that's a highly relevant value proposition in this market.
Well, as you've been speaking, we've been showing some of the market share of China's biggest EV makers on the screen as well. And you noticed this as well, that the market is becoming more and more concentrated in fewer hands, you know, the likes of BYD, Geely. Do you see further consolidation taking place here? And how many big car brands are we going to end up with in China?
Yeah, well, first of all, there are, historically, there have been over 100. We're probably down to, as we look at the market right now, 10 companies generate 80% of the new energy vehicle sales. 5 companies, which includes Tesla, generate 60% of the new energy vehicle sales. And BYD, the leader, generates about 1/3 of all the new energy vehicle sales. So important to note that this is already a very concentrated market. It will consolidate because you can't run a business on very low volume in this industry and survive for very long. But there are going to be 2 lanes of those survivors. One lane is the hardware commoditizers, the ones who basically can only compete if they can price aggressively at scale. They're not going to necessarily differentiate themselves with software and technology. But you've got another lane, and that lane exists in China. Xiaomi's in that lane. Huawei's in that lane. Frankly, Tesla's trying to compete in that lane. And others like XPeng and NIO are struggling to generate the same volumes as what we've seen from Xiaomi. But they're going to differentiate with electronics and human-machine interface, smartphones on wheels. That'll be the 2 lanes of competition, and we'll see consolidation in both lanes.
I want to get your views, too, on opportunities offshore for some of these Chinese EV makers. I mean, we see the US, Europe putting up barriers to protect their domestic car industries. But here in Australia, where I am, there is no longer a domestic car industry. And we're starting to see a few Chinese models on the roads now. How much growth is there offshore in markets such as Australia, Mexico, others?
Huge. 1 out of every 5 cars that are made in China are actually being sold outside of China. And as I've said before, if you put a dam on a river, it doesn't stop the flow of the water, it just reroutes it. And China, instead of going to the US, instead of attacking Europe directly, they'll go to the emerging world. That's the global south, and Asia. I would put Australia in that category. It will be Central Asia, Middle East, Latin America. China is going aggressively to those places. There were 5.9 million exports from China last year. We're going to see a number somewhere around 6.5 million this year. The penetration of electric vehicles into that number is about 1/3 this year. So China's going to go to the world with affordable, electrified mobility. And I think we're going to see more and more of that, in particular in the emerging world where affordability matters more.
Well, we've seen Xiaomi come to the fore with its innovative ecosystem that we've talked about. So what are the next developments in the EV space that you're looking out for? Any manufacturers with an edge in any particular area, such as battery or range or anything like that you're watching out for?
Okay, let's take the super scaler in the EV lane, which is BYD. BYD makes its own batteries, is highly vertically integrated, and can compete aggressively on price just simply because they have the highest cost component vertically integrated, and they have the scale economies to compete on price. BYD is significantly pushing on exports. They increased their export volume by about 200,000 units this year. They're now the number 2 made in China exporter. But you've got companies like Chery, Chang'an, SAIC with MG brand, all aggressively moving into those global markets, in particular to what we call the emerging world, global south, Middle East, Latin America, and I would put Australia in that target zone. The markets without high barriers with tariffs to entry. That doesn't mean China's not going to Europe. I've been to Europe 3 times this year. There's very strong pull coming from the European market for affordable electric vehicles, and Chinese companies are building their beachhead. They're going to start from Eastern Europe. The tariffs don't stop China. It actually just reroutes the water not from made in China, but from building factories in the region. So we'll see factories from BYD being built in Hungary, in Turkey, and plans for capacity expansions in Southeast Asia and eventual plans for Mexico and Brazil. So the Chinese companies are going global. They're going to do it with localized production. There's precedent for this. The Japanese, the Koreans, all the global auto industry went global, not with building everything in the home country. That's how you start. Eventually, you go global with factories around the world.
All right, we're out of time, but thank you very much, Bill Russo, founder and CEO of Automobility, for your analysis today. Former Deputy PBOC Governor, meanwhile, Zhu Min, has said China's AI advancements are about to unleash a wave of more than 100 DeepSeek-like breakthroughs in the next 18 months. Our Chief North Asia correspondent, Stephen Engel, gives us a closer look at the country's progress in humanoid robotics, also known as embodied or physical AI.
Embodied AI is all the rage in China, from industrial automation to autonomous EVs, from delivery drones to increasingly advanced robotic humanoids and pets. AI is on board, and with their sensors, motors, and natural language processing, now they're interacting with us and the rest of the physical world, and it's arriving in much more lifelike packaging, as creepy as that may be. China's Ministry of Industry and Information Technology says China since last year has produced nearly 100 embodied AI robotic products, claiming the country holds 70% of the global market, due largely to its unrivaled stem-to-stern supply chain of critical parts and advancements in its own AI and chips. The embodiment, if you will, of China's DeepSeek moment.
I think that ushered in a whole corporate culture where we're trying many Gen AI use cases. We have also labs and PhDs who are working on these things. When would this ever impact the bottom line or have real impact? I think that's the question.
We do know that the central government has put out a venture fund tapping about $138 billion for the development of humanoid robots for industry and for personal use. That is a lot of money and probably just the tip of the iceberg. In an otherwise difficult job market in China, online recruitment firm Zhaopin says the number of job openings in China's humanoid robotics sector has quadrupled so far this year from last, with salaries for the needed algorithm engineers rising well past the average urban pay. Hangzhou-based Unitree is one of the pioneers of consumer robotics in China, offering its latest so-called humanoid agent AI avatar, the 4-foot, 2-inch, 77-pound G1, on the web for $16,000. He can do all kinds of things. He can run, he can jump, he can get your coffee. Or for $1,600, there's the 4D ultra-wide recognition LiDAR-equipped Go-To dog, with plenty of tricks up its 12 flexible knee joint motors.
It can stand. It's just the beginning stage.
For China's vast industrial complex as well, rapid automation includes the increasing use of inspection and diagnostic bots with embodied AI, such as Lenovo's six-legged Daystar, deployed in places unreachable by or unsafe for humans.
I think the Chinese robots will come into the world, in a way that as a price for money and a price of value, that will be quite unbeatable.
With the backing of state policy and funds, expect a myriad of new embodied AI products to try and grab your attention. Like it or not, we may be staring directly into the future. Stephen Engel, Bloomberg News, Shanghai.
Just get you some breaking news out of India on the deals front. We're hearing that JSW is going to acquire Akzo Nobel India at a $1.4 billion euro valuation. If you're not familiar with the company, it is involved in paint and powder coating business, and JSW also has interests in that area, so a lot of synergies there. JSW, a private company. So Akzo Nobel is going to sell its India unit to JSW Group for 1.4 billion euros. Akzo Nobel says 900 million euro net cash proceeds from that India unit sale. Still to come, Commerce Secretary Howard Lutnick says President Trump's closing in on a trade deal with India. Got more details next. This is Bloomberg. Earlier we were talking about how Nike is caught in the tariff crossfire. Well, Japanese chip equipment maker Tokyo Electron too is stuck in a tough spot as the US moves to restrict China's access to tech. With half its revenue tied to China and as Beijing accelerates its AI push, the stakes are rising. We spoke to CEO Toshiki Kawai to unpack what that means for the company's strategy and the future of global semiconductors.
Until recently, it was around 45%, so nearly half. Investment in other regions aside from China will grow, so the ratio of China's sales to total sales will inevitably decline. About 35 years ago, China's sales ratio was around 30%, and I expect it to settle at around that level.
How long do you think it will take for Chinese equipment makers to catch up when it comes to technological advances to become a real competition to the likes of Tokyo Electron?
Actually, there is a gap with China's technology. I think it's possible to maintain the difference in technology between China and our company. I'm sure that Chinese vendors are trying to catch up with us, but we must be faster. We can be faster than them in technology innovation, and that's how we can maintain or increase the difference. We are the SPE manufacturer, but we are not chip makers. So, for us, it is key to work with the world-leading chip manufacturer to develop the best-in-the-world process and best-in-the-world equipment. The pace of technological innovation is likely to accelerate. I believe this gap will continue to widen. Tokyo Electron is always pursuing the latest cutting-edge technology, so we believe there will be no issues with our growth.
What happens if the needs of the customers change? Because this year we saw the changes brought from DeepSeek with cheaper models, more efficient models that perhaps might need less hardware. Will that change your calculation going forward when it comes to what's needed for the next generation of advances for artificial intelligence?
The emergence of various AI solutions means there is potential for many applications, and the number of applications will increase. As a result, we can expect the overall use of semiconductors to expand. At the same time, the common global goal is finding a balance between digital transformation and green transformation. This will require technological innovations in semiconductors. With increasing applications, there will also be a demand for high capacity, high speed, high reliability, and low power consumption. This has been a constant necessity since the invention of the transistor radio 76 years ago. This pursuit of technological innovation will continue. Even as various AI solutions emerge, the demands don't change. I believe that the devices themselves will continue to expand.
How has the ongoing trade war and the uncertainty over tariffs affected your business and how you're preparing right now?
At this moment, tariffs are not applied to semiconductors. For example, if we look at Tokyo Electron's sales this year, the United States market accounts for 8%. Considering that tariffs are not currently in place and that the sales share is 8%, we believe the short-term impact of tariffs will be limited and minimal. But we need to continue monitoring developments. We have to watch the progress of tariffs. Our value lies in how we improve and enhance productivity, cutting-edge technology solutions, and productivity enhancement. We will discuss with our American customers and partners how to create solutions that go beyond these tariffs. We also see this as a business opportunity.
Tokyo Electron CEO Toshiki Kawai there. Let's take a look at how Indian markets are tracking at the moment. We've got both the Nifty and the Sensex on a three-day winning streak at the moment. Those key India gauges hovering around the highest we've seen in about 9 months now. Financial services, metal stocks have been performing pretty well. The Reserve Bank of India has also remarked on the strength of lenders. But you see there on the screen there, Akzo Nobel India. This is a paint and powder coating company, up by 3% right now after signing an agreement to sell to JSW Group for a value of about €1.4 billion. President Trump and Commerce Secretary Howard Lutnick said the US is very close to the finish line when it comes to a trade deal with India. His remarks came as India's negotiating team arrived in the US for further talks. For more on this, let's get to Bloomberg's Shruti Srivastava in New Delhi. Sorry about that, Shruti. So what can we expect from this fresh round of talks?
So, as you said, President Donald Trump yesterday made the statement that there is a very big deal coming with India probably soon, where American goods are going to get access to Indian markets. This comment comes at a very interesting time when an Indian negotiating team is in Washington to advance the talks. Both the sides have hardened their stance on a couple of key issues. So the team is there to find a common ground and see if these differences can be resolved to secure an interim agreement before the July 9 deadline kicks in. Now, from July 9, higher reciprocal tariffs are set to kick in. So countries are racing to secure a deal with the US to avoid those punitive tariffs. A lot of water has flown ever since India and the US started negotiating. From going all out to appease the Trump administration by giving sweeping concessions. Now India has hardened its stance, especially in view of China getting a deal despite its defiance. So let's see what comes out of the negotiation. The team would be there for 2 days and they would try to find common ground to resolve the differences.
Yeah, so progress has been made, as you say, but what are the key contentious issues that continue to linger around the negotiations?
So in the first, both the sides were discussing, having a deal structured in 3 phases: an interim deal before July, and then a deal by a broader deal by fall, and maybe the rest of the issues by maybe next year, as we had reported earlier. But for the interim deal, the idea was to have a quick deal with low-hanging fruits. However, both the sides have dug in their heels on some of the key issues. For instance, America is demanding that its genetically modified crops should be allowed access in India. And the Indian government has strictly said no to that demand. So that is one of the key asks from Washington side. From the Indian side, the negotiators have made it very clear that they are unwilling to accept a deal which does not address their concerns on reciprocal tariffs and sectoral tariffs. Now, the Indian government has demanded that the US does away with the entire reciprocal tariff and gives its the best offer which it will give to other nations it's negotiating with on sectoral tariffs.
Yep. All right, Bloomberg's Shruti Srivastava there in New Delhi. Before we go, let's take a quick look at some of next week's guests. We're going to be having market analysis with Schroders Group CIO Johanna Kirkland and Lombard Odier's Asia CIO John Woods as investors weigh Fed policy and, of course, progress on tariff talks. But that is it for Inside Horizons Middle East and Africa coming up next. This is Bloomberg.